Welcome back, investors, to Ticker Time News. I'm Adam, and it was a rough session for the stock market on the heels of the September employment report, a broad-based sell-off that was accelerated by a jobs report that reflected continued strength in the labor market, stoking concerns about a continued aggressive rate hike from the Fed. Now, I have to admit, yesterday I made a mistake. I said that if the jobs data was good, that the market may be able to break that 20-day moving average resistance that has held it back all week. But the jobs data today wasn't just good. It was really strong. And that is what scared the stock market into thinking that the Fed is going to stay aggressive. Now, despite today's heavy sell-off, the market was able to hold on to gains from the big rally on Monday and Tuesday. The S&P 500 was up 1.5% for the week. The Dow Jones was up 2% for the week. For the NASDAQ composite, it wasn't up as much, but it was up 0.7% for the week. The market was led lower today by weak mega cap stocks. The first thing I want to look at here before we dive into the mega cap ETF is the SPX for the S&P 500. You can see that today's gap down this morning left it sitting right at the top end of the weekly expected move, and then the rest of the day it sold off until about the last 45 to 30 minutes of the day. The market kind of popped back up. Now, let's look at the SPY. Very similar story right here, except the SPY's wick was up above the weekly expected move today. Let's open this up a little bit here as the lines load on the chart. Up we go. Almost there. Okay, there's the lines. And you can see, too, that it did open at the weekly expected move, but during late morning, it tried to get a rally going, but that was just put out. Real quick, put out. And it just fell the rest of the day, again, until about the last 45 to 30 minutes of the day. And it settled right here within the weekly expected move, underneath the 369, closing at 362. Now, let's go to the Qs, a little bit different, because while the S&P was down 2.8%, the Qs were down 3.8%. So a much bigger drop. And you can see that it took place this morning. As I bring this chart up, you can see the gap down from yesterday's smaller candle to today's bigger candle, leaving it still within the weekly expected move for the Qs. Down goes AMD. Oh my gosh. I'm going to talk about semis here in just a moment. They had it bad today. Now, let me pull up the IWM here real quick. It was down 3% on the day, fell right back into the weekly expected move. It opened just slightly above the upper end of the weekly expected move, but of course, with that 3% drop, it did land right there in the middle. I am going to be curious to see where the options market takes the weekly expected move for next week. This week, the options market was a little hesitant on going too high with the upper end of the weekly expected move. It was much lower this week than it was last week, and we just happened to get data that moved the market in the right direction, which was down today, which put these major indices right in the weekly expected move segment there. All right, let's go to the mega cap growth ETF. The ticker symbol is MGK. It closed down 3.8% today. And you compare that to the, all right, there we go. Compare that to the 2.8% loss in the S&P 500. So broad base, S&P 500, 500 stocks, but here it's just mega cap growth down over 1% more than the S&P 500. So the mega caps definitely were a drag on the market. All right, let's go to SMH as the ticker symbol, and let's talk about those semiconductor stocks. They were another drag on index performance today. The Van Erik Semiconductor ETF, which is what's on the screen right here, it closed with a 6% loss. and this was all after Advanced Micro Devices, AMD, was down 13.9% on the day, because yesterday in the after hours, it slashed its revenue and gross margin guidance for Q3, citing a significantly weaker PC market. Now, in a few moments, I do have some updated data on Q3, and buckle up, it's not looking good already. There have been some companies that have already reported for Q3, and we're going to talk about that in just a moment in this new report that was out. Now, the weak showing from semiconductor stocks, they contributed, that's what I'm looking for, to the underperformance of the S&P 500 technology sector. XLK was down 4.1% and closed in the last place for the 11 S&P 500 sectors. Now, the tech sector was able to squeeze out a gain for the week of 1.6%. And that all goes back to the big moves in the mega caps on Monday and Tuesday of this week. That's what kept them afloat. Same thing here with the mega cap growth ETF, ticker symbol, semiconductor. Same thing here with the semiconductor ETF, SMH. It was up for the week because of the giant gap up that it produced on Monday going into Tuesday. Huge gap up. I think the gap down this morning, probably about equal size in the gap that it made. But yeah, that's the only reason it was able to finish in the green for the week. Now, the energy sector today, it was down 0.7%, and it spent most of the session in positive territory and closed with the slimmest loss as oil prices surged. Let's go to U.S. oil on the chart. WTI crude oil futures rose 4.5% today. I did not think oil would go up so much today. I thought it would cool off today, but it didn't. 4.5% going right through that green bar on your screen to $92 a barrel. The sector also logged the biggest gains on the week, up 13.9%. Now, speaking of big gains for the week, our top 10 momentum stocks list had a good run too. Our top 3 out of our top 10 plus the bonus 5, our top 3 momentum stocks this week, XOM, OXY, and CXV all gained double digits. Let's look at XOM, which is Exxon Mobil. They were up 14.6% on the week. Giant boost. They did lose a percentage point today. The same thing. Oil was up big today, but all 3 of these, XOM, OXY, and CXV, all lost about 1% on the day, I guess because people were taking profit from a giant momentum run this week. Now, just to back up what I'm saying here, OXY, we'll pull that one up. We mentioned these earlier in the week. I don't normally do this for the live streams. I save it for our private investor community, but I wanted to bring them up early on and then track them throughout the week to see how they did here live in a public setting. OXY gained 14.8% on the week, but you can see here it lost a percentage point on the day. Now, the last one is CVX. Let's load that. It was up 11.1% on the week, but it still dropped a percentage point on the day. So I just wanted to show you, earlier this week, I shared our top 3 momentum stocks for this week. We tracked them this week, and here's how they did for the week. So we've got XOM up 14.6% on the week, OXY up 14.8% on the week, and CVX up 11.1% on the week. Now, we put this out every Tuesday before the market opens. That is our goal, to get them out. We've been doing a lot better with doing so. as we grow our private investor community, we just want to continue to do better and better and better. And these are the results that we want to try to do in a bear market, like we are here, where the markets are down 3%, 2% or more today. We've got some momentum stocks that actually buck that trend. Compare that to the S&P being up over a percentage point, being up 14%. It makes a difference. Now, if you would like to get our top 10 momentum stocks list, weekly expected moves, numerous trade ideas, and more to help you along your investor journey, then just click the first link in the description. It's that easy. Now, another headwind for equities today was rising Treasury yields. Let's look at the 2-year. US 0 to Y will take you there on TradingView. There is a link in the description for TradingView. Doesn't cost a penny and it's free to use. Okay, but they do have paid plans to get more of the features. Just pointing that out. The 2-year. It rose 7 basis points on the day and 10 for the week to 4.3%. It's up a little bit in the after hours to 4.31%. I know we've been talking about this. It had its expansion move. It's been contracting, and it seems to be making a move here at the end of the week. The last 3 sessions, it's been on a move, but we had expansion, and expansion leads to contraction, and then contraction leads to expansion. Is this expansion going to kick off further and go higher, or are we going to have a cooling off period for the Treasury yields? Next week, with the CPI report, that will be a big deal for equities, for the Treasury market. And I've got the forecast for CPI report. We're going to talk about that in just a moment. But let's look at the 10-year real quick. US 10Y for the 10-year. The 10-year rose 6 basis points on the day, 8 basis points on the week to 3.88%. You can see it reached a high last week. It pulled back, broke underneath its trend line, but it held its 20-day moving average, which is significant, and it's been on the rise ever since. So again, a long track of expansion leads to contraction where it's at right now, which leads to expansion. Is it going further? CPI is going to be the determining factor, whether it's going to go higher or not. Now, yesterday, we started to talk about the upcoming earnings season. And today, FactSet, let's pull them up. This is the report right here. I'll put the link in the description. I totally forgot to do that. So right now, I'm going to put the link in the live chat. Just in case you would like to grab it here. Little copy and paste job. There we go. Aha, boom. All right, it's in the live chat. I haven't added it to the description of this video yet, but as soon as we're done with this live stream, I will add it. Now you can see the title here. 50% of S&P 500 companies citing a negative impact from FX on Q3 earnings calls to date. Out of the S&P 500 indice, okay, out of the 500 companies, 20 companies have already reported their Q3 earnings. Now, FactSet went and looked at those 20 companies, and they put in keyword searches for currency, labor, etc., volatility, uncertainty, pressure, headwinds, etc. And they were looking to see whether these 20 companies in the S&P 500 were positive, negative, or what have you, okay? What did we learn from this report here? What did we learn from these 20 companies? Or I should say, what did FactSet learn that they shared with us? One problem was labor cost. Most companies mentioned it as a factor that either had a negative impact on earnings, revenue, or profit margins in Q3, or is expected to have a negative impact on earnings, revenue, or profit margins in the future quarters, like Q4 or even Q1 of 2023. Other problems were supply chain disruptions and cost. Here it is. It's Q3 2022, and we're still talking about supply chain disruptions. Remember at the end of last year, so many people were talking about, yep, we expect by the first half of 2022 that the supply chain disruptions will start to ease and wither away. No, we're still talking about supply chain disruptions and higher transportation cost. Now, the other big unfavorable portion here is in the title. Unfavorable foreign exchange rates. What does that mean? A strong dollar is hurting multinational companies. So let's go over here to the DXY. That's the ticker to track the US dollar. And you can see the Adam, I didn't see what Newsom did. What did he do now? Oh my goodness. I can't, are you, maybe the checks that he sent out, $1,050 for a family? Is that what you're talking about? Or is it something newer or crazier that he did? I mean, inflation is high. Why would you send out money? I mean, I get the political play there, right? Yeah, okay, I gotcha. I get the political play there. That gas went up, so these are supposed to be $500 gas checks or whatever the case may be, bumping it up for over $1,000 for a family. With the state of California basically handing out more money, prices are already high. That's not going to fix the problem. But I do understand the political play here. It looks wonderful giving out, quote, free money right before an election. I get that play and I get that narrative. I understand it. But just, I know it's tough for people too. I know it's tough out there. Inflation is a hidden tax that hurts the most. Yeah, California, they do spend a lot. They do a lot of crazy things, which is probably why, remember when we were talking about real estate, and then I'll get back to the dollar. When you're looking for a state here, right, that has the most color in it, Florida is pretty filled up with color, and a lot of it is purple. But the other state that is really like full of color is California, all except for a northern part of California, and maybe brown will stick out. This northern part right here of California is kind of like the only like dead zone here where home prices aren't overvalued. And of course, we pointed out a couple of spots where they are undervalued, kind of central to the north on the coast. But the rest of the state is covered in dark reds, oranges, and purples. So yeah, California is expensive. It looks like for home prices right now, though, Florida might have them beat, but man, it's rough. It's rough. But sending out that money, it's not going to help. Well, let me say that in two parts. It will help people in the short term, but it will hurt the same people in the long run. That's what those checks are doing. So, I mean, we can see it. We have seen it with the federal government, the central bank, all printing money, handing out money all through 2020, start of 2021, and it is now, or it has been in 2022, affecting the inflation rate. And that's why inflation has been so high. And that's why the Fed's got to hike rates and do quantitative tightening to get that money back that it put out there. So whenever governments are sending out money or printing money, it's always a short-term fix, but there's a long-term consequence to doing it. And we've been going through it, the consequence here in 2022. Okay, a strong dollar means that when companies that work in other countries, when they bring that revenue back and they have to exchange it for US dollar, with the US dollar being so strong, that exchange rate is unfavorable to those companies. And that can hurt a company's bottom line. So 50%, well, that's only 10 companies. So let's just, the 50% seems like it's a real big deal. But remember, it was only sampling 20 companies in the S&P 500. So 50% is only 10 companies. Small sample size, but it's important to know, because if this trend continues, this is shaping up to a no good Q3 based on what's been reported already. So buckle up for Q3. It starts in a week or so. So get ready for that. Okay, CPI. Let's go back here to the SPX. And this is all I had for today. It's kind of short. Got a little behind myself here. And of course, the live stream started late too. So let's talk about CPI for just a moment here. It's coming up next week, the CPI report. That's the read on inflation. A little piece of data that I found is the average open for the SPY. And actually, we should just go to the SPY for this instead of the SPX. When CPI has been reported, and it's always reported, before the market opens. So the market has time to react a little bit to the inflation data that they just received. So in 2022, on CPI day, the SPY is down just under 0.5%. So when the market opens on CPI day, so far in 2022, the average is a decline of just under 50% right at the open. I found that to be interesting data. So we may be able to use that to our advantage when it comes to CPI day. Now, the expectation for CPI this go around is 8.1%. Now, I have seen some preliminary numbers, which I don't necessarily know the track record, so I can't say that, they're right 75 or 50% of the time. But I've seen some preliminary numbers that are saying the inflation read will be 8.3%, which means inflation coming in hotter than the 8.1% expectation. So use that, put a grain of salt, sprinkle it on. I don't know how accurate that preliminary number is, but I did see it. Now, inflation may just tick higher this time. And remember, a month ago, it was a concern of mine that October we could tick up a little bit higher than expectation. But that happened on core CPI last month. So over the past month, I've been thinking to myself that maybe I got it wrong and I was just a month late on thinking that. But now, if you go back over the past month, you look at commodity prices, oil, for example. Let's go to oil. Look at some of these prices over the past month. Just seeing what they have done, right? So here's oil. Let me go back. I want to go to September 1st. Put a marker. Oh, that's not right. What did I do? Okay, let's go to September 1st. There's the vertical line. And now we're going to go to October 1st. Well, October 3rd. That was the... All right. So over the past, excuse me, over the past month here, let's do this. I'm going to get the trend line out. So the month opened there, okay? And then right here. So what's the trajectory here for oil? The trend line there from the open of September to the open of October, it is slightly going down, okay? This is oil. Oil is excluded from core CPI, but it's not excluded from the all full out CPI report. So maybe this shows that inflation has come down from the last reading that we got. Okay, let's do one more little test. Let's go back to the beginning of August. And we'll put a vertical line, the beginning of August, which was the 1st. Right there. Now let's do that same trend line. So it opened down here, right? Okay, and then it closed down here. All right, and let me just make that a little bit thicker so it's a little easier to see. This is not rocket science, nor is this a proven way to measure to see if inflation is going up or down. But if you notice those two blue lines, it looks like last month's report, at least looking at oil as a commodity only, it dropped a little more sharply for August than it did in September. Now, one thing that I noticed with these lines here is that, and let me get the highlighter here to show it out, is that during the August report, it ended on a high note. Let's get this out. So oil was ticking up right into the end of the month. Well, oil was down low, but it also ticked up at the end of the month. I don't know, just a little something there. Something else to notice too is that the high here is much higher. Let's see, it was exactly $97, but the low here is much lower at at $76. So just with this, and again, it's not scientific, it probably has nothing to do, but it's just something that I'm thinking about when thinking about inflation. And you can go through and look at all the different indicators that the Fed uses for the CPI. Maybe CPI did come down. Maybe inflation did drop. I mean, there was a lower low in September than there was in August. And August had a much higher low. So maybe. But it does look like the price in August, just looking at the open to close for the month, did go down a little bit more steeply than it did here in September. So just something here to think about while we're thinking about inflation. So I guess what we could say here about CPI is that if you're bearish, then the simplest thing that you can do, and especially with that average of just under 0.5% open for the SPY, if that average continues, that's obviously a bearish development. But again, I wouldn't put a lot of weight on what the market has done in the past because it can totally change in the future. As a matter of fact, let's just go back here to the SPY and look at this. The market is a lot lower right now than it was a month ago when the inflation data came out. I mean, we go back and look, it was a pretty big 3.3%. No, that's not the, is that? No. It's this one, I think. Well, this is a 4.3. That's even worse. No, that was Jackson Hole. That's right. And that was FOMC. I'm forgetting what the date was. I thought I had it marked on here. Maybe it's SPX where I have it. Okay. Anyway, the market is much lower this month, and it will be next week when CPI is reported. So, also have that factored in to what you decide to do. But if you are bearish on inflation coming in, maybe meeting expectation, if that happened, I'm not sure that there would be a big rally with still inflation at 8.1%, because that still means that inflation is sticky and it's hanging around. That's not going to make the Fed happy. They're just going to continue to push on, raising rates. Now, if you are trading options, one of the simplest things to do is just to make sure you're covered on both sides and then play it once the market moves. Or if you're bearish, just a very simple long put, not too far out of the money if you're bearish. So just remember, though, that I don't know, other YouTubers don't know, nobody knows what's going to happen on CPI day. But by taking in all the perspectives, all the data that you can beforehand, plus lowering your risk and keeping things as simple as possible, and you should do all right. Now, I see your comment here, a combination CPI, FOMC, and midterm. Let's put this up on the screen here. As a matter of fact, I'm going to come over here and I'm going to get this back out just because this comment, it reminds me so much of what is actually going on here. Almost there. One quick second. I'm pulling up an image to put up on the screen. And it is the image I've showed several times before. Excuse me. That shows, I got it right here. I'm going to open it up. It should be popping up on the screen here. Okay. Let's see. Can I make there? Whoa, really big. Okay. So here we have it. This is showing historical data. I've showed this before, going all the way back to 1946. And let me just get that. Let me get this opened up here. I want to draw. Let's make it as big as possible. Okay, so we have here seasonality chart, but it's focused on also charting midterm elections. CPI, FOMC, and midterms. They are going to play a big role in the second half of October. And that second half of October could technically kick off next week. Not much of a rally in the front half of October, has it? No, not with today's big drop. But the black line, which is at the top, which shows, a bull market, is all years combined. But what we need to focus on is what's more relatable to where we are in history, which is the red line. This is the second year for a new Dem president, okay? Joe Biden, he's in his second year of office, and he was a newly elected Democrat president. The red line is what we need to focus on. So if we look here, we have a low. Oops. I thought I was drawing on here. We have a low right here in June. Then we get a summer rally, right? And then we get a cool off and we get another low that undercuts the June low, or at the very least comes real close to it in the middle of end of September. Then we get a October rally, the first couple of weeks. So the front half of October, we get a rally. And then the second half of October, which this doesn't have to be precise. This could move forward by 1 week. And it still lines up. I mean, the lines are not perfect, but they're pretty darn close. We get a dramatic fall in the back half of October that creates a new low for the year that undercuts both the June low and the September low. And then after the midterms are over with, we get a little rally, another little pullback, and then a rally into the close of the year. Because the market probably gets extremely bearish and oversold at this new low for the year right there. That what other headwinds do we have once we pass the midterm elections? Well, we still have CPI reports, FOMC meetings. But one thing that is interesting is there is no FOMC meeting in October. So there will not be a rate hike in October unless the CPI report comes out, PPI comes out and says inflation has gone back up. The Fed could call an emergency meeting to hike rates in October. They could do that. If inflation is within a few points of expectation, even on the upper end, I don't see the Fed coming out and doing an emergency meeting to hike rates in October. It's possible, but I don't see it happening yet. If inflation is like way over the expectation mark, like 8.8 or greater, maybe the Fed would step in at that point with an emergency meeting and an emergency rate hike, but I just don't see that happening. Not at all. Okay, so there you have it with the historical data here to look at as well. It's interesting to check in on time to time just to see how things are playing out and to see how accurate it has been. And so far this year, I mean, it's got the two lows of the year, the June low, which was a major one, the summer rally, and the September low, all right there in front of you. All called out before they even happened. And this is projecting an October low that undercuts it all. Is it possible? Is it possible that, there we go. Is it possible that today's reaction, due to a very strong jobs report, the beginning of that October crash, will CPI be a quote October surprise? That's typically, when we're in an election season like the midterms, we have an October surprise that's supposed to wreck one candidate or the other, are we in the market going to get an October surprise? Well, looking at the seasonality chart, yeah, some kind of October surprise to send us to undercut and make a new low for the year. That means we would be going underneath on the SPY 356 to undercut that low. We'd have to go under 356, and we're not that far off. We're not that far. We're less than 10 points, right? 56, yeah. We're less than 10 points away from undercutting that low. So yeah, it could happen. This orange line right here at 350, 3,500 on the SPX or the S&P 500, that is a critical level of support. That is right around the 50% retracement from the March 2020 low to the January 2022 high. Incredible that 50% would have been given back. Okay, that covers all my notes for today. Don't have anything else to talk about. But if you have a question, now's a great time to do that before I wrap up the live stream. Anything that you want to ask, go ahead. And while you are doing that, if you could do me a quick favor and click that like button. Also, share this video with a friend. That's very helpful to this little tiny channel. And if you're new here, consider clicking subscribe. And if you like the perspective and you want more of it, then consider joining our private investor community by clicking the first link in the description. I think you'd really like it. Weekly expected moves, numerous trade ideas, top 10 momentum stocks, other top 10 stock categories like value, dividend, growth, economic and market insights, private and public Discord server, all to help you along your investor journey. So I'd appreciate any support to help us out. That would be great. So again, that's all I had for today. I want to thank you, ladies and gentlemen, for joining me. Have a wonderful weekend. And for our investor community, tomorrow, Saturday, there will be a note going out. It'll be on our Patreon page and our Discord page, talking about the upcoming earnings season and going into it with a little more detail. Also, Sunday evening, be on the lookout on our Patreon and Discord for our weekly expected moves for over 40 products. Actually, I think it's, 50 or so products now. So keep an eye out for that. Those two things this weekend. Other than that, have a wonderful weekend, and I will see you in our next live video Monday after the markets have closed. So have a wonderful weekend, and I'll see you in the next video.